Today we are going to take a look at Snowflake. Stock ticker symbol SNOW. It is headquartered in the USA and service regions all around the world. It has a market cap of 46 billion and is considered a large cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the information technology sector and software industry. Snowflake provides a cloud-based data platform in the United States and internationally. The company's platform offers Data Cloud, which enables customers to consolidate data into a single source of truth to drive meaningful business insights, build data-driven applications, and share data. Its platform is used by various organizations of sizes in a range of industries. In short, it is a cloud-based data platform trying to democratize data analytics. It has a 5-year compound annual revenue growth rate of 88%. The revenue growth is consistent and the revenue trend looks very strong. The revenue trend is important as growing companies often have sales go up first followed by profit growth. On the other hand, when sales become stagnant, it may also give us a hint that the growth phase of the company may come to an end if no critical change is made. It is not profitable now. The net income trend looks very bad. The profit is going deep down in the negative. This is not a good sign. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has been issuing more shares in the recent years, probably for funding its growth. We should always follow closely if a company is buying back or issuing more shares, as both of these activities greatly impact the return shareholders can get. It does not pay a dividend yet. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of Snowflake is very bad and significantly lags the performance of the SPY. Snowflake has a 2-year total return of -64% with a 2-year compound annual growth rate of -60%. Currently, the price is at around 145 with a 52-week high at 405 and 52-week low at 126. It is near the lower end of its 52-week range. It has a P/E ratio of -67 and forward P/E ratio of 1100. Snowflake is considered a no-moat company according to Morningstar's rating. Currently, the margin is -56% and future margin after 5 years is expected to be 10.5%. The margin is expected to be increasing a lot after 5 years. The company's margin and moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. Now, about the future projection. It has a 5-year forecast revenue compound annual growth rate of 48% and 5-year forecast EPS compound annual growth rate of 35%. The near-term growth is expected to be very good. It has beaten all of analyst consensus EPS estimates in the last 4 quarters. Looks like it's on the right track to success. The overall analyst recommendation rating is a buy with trend shifting towards hold recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 31 analyst 1-year price targets, the range is 190 to 575 with an average price of 313, which is well above the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 3 kinds of discounted free cash flow model results for a more comprehensive review. If we run the DCF perpetuity growth model, the fair price is 109 with a downside of 22%. If we run the DCF terminal EBITDA model, the fair price is 130 with a downside of 7%. If we run the DCF terminal revenue model, the fair price is 140 with a downside of 4%. Now we compare Snowflake with US Treasuries and SPY. It cannot be emphasized more that the U.S. 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 3%. The return yield of SPY is at around 10%. The SPY has an average forward PE around 17.5 now. Snowflake has a dividend plus 10-year growth forecast plus shares buyback yield at 32% and a forward PE around 1100. We have to be cautious that this is just a rough prediction of Snowflake's future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like Snowflake is more expensive than the SPY, and SPY looks like a better buy with a more stable return estimate. We will try to summarize all the information above to give us an overall impression of Snowflake. In summary, Snowflake is a large cap and profitable company with good growth and no moat, and probably overvalued now. If Snowflake can deliver more growth than estimated and turn to profit faster, it may be a stock to consider. Now that's a review for Snowflake stock. Click the subscribe button for more up-to-date stocks review. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time.